Welcome back to the Deep Dive. Today, we're digging into a really exceptional set of source materials.
They really are.
It's a detailed analysis of global market trends, focusing specifically on gold and silver right through the end of 2025.
And it's a late-breaking bulletin, too, so the data is about as fresh as it gets.
Exactly. It's packed with data that, it really suggests the financial landscape fundamentally changed this year.
Okay, let's unpack this. When we talk about 2025, we're not just talking about a good year for precious metals. We are talking about something historic.
Yeah, historic is the right word. An almost unimaginable surge that I think caught nearly everyone off guard.
It really did. By late December, the numbers, well, they speak for themselves. Gold posted gains exceeding 70% for the year.
Which is a huge move in its own right.
A huge move. And then there's silver, and get this, it soared by a shocking 142%.
142%. How do we even process a number like that? 142%. Is that simply unprecedented outside of, some highly volatile penny stock? It just demands we look deeper.
It absolutely does, and that's precisely why the sources you've shared are so compelling. These weren't just spectacular gains, they were a systemic response.
The response to what exactly?
To years of building pressure. So our mission in this deep dive is to synthesize the numbers and, the stories behind them. We want to help you understand why these movements signaled a real erosion of trust in the traditional fiat financial systems.
Right.
This surge reflects a structural recognition of persistent inflation and monetary pressure that's been building for a long, long time.
Let's ground ourselves in the numbers for a second because they highlight just how quickly the landscape really shifted.
Okay.
Silver started 2025 at around $30 an ounce. A decent price, nothing crazy.
A solid starting point.
But by the close of the year, it was hovering near $72.
Just an incredible run-up. And gold did something similar, just on a different scale.
It certainly did. It established an all-time high of just over $4,500 per ounce.
The magnitude of those figures is astonishing, but what's more critical, and the sources really hammer this home, is contrasting the nature of the 2025 rally versus previous spikes.
Okay.
Yes, silver significantly outpaced gold in percentage terms, a massive move, but the drivers were entirely different from what we've seen in the past.
You're referring specifically to the 2011 spike in silver, right?
Exactly.
That was characterized largely by enthusiasm in the paper market. It was futures contracts and speculative buying.
Correct. That was a speculative fervor. It was driven by the expectation of price, often based on these, abstract financial claims. The 2025 advance, however, stemmed from something far more tangible and far more stubborn. Structural supply-demand imbalances and, crucially, a collective realization of monetary devaluation. Physical demand became paramount. It completely overshadowed the abstract paper market.
And this foundational shift, this growing awareness of monetary devaluation, that connects directly back to your immediate everyday life.
It has to.
If inflation is outpacing the returns on conventional savings accounts, on government bonds, throughout the entire year, you stop viewing your savings as security.
And you start seeing them as a source of anxiety. That's the key insight. The source material highlights this using a really relatable benchmark. Year-end holiday spending.
The Christmas benchmark.
The Christmas benchmark. Consumers, regardless of their native currency, reported snarkily higher expenses and this pervasive anxiety over how far their household finances were stretching.
I see.
When you see persistent inflation eating away at your purchasing power year after year, people are forced to confront the diminishing value of their paper wealth.
And they start looking for something real.
They start looking for a real, physical store of value.
It's the difference between nominal wealth and actual purchasing power, isn't it? You might have more money in your account, but if that money buys 10% less turkey and tinsel every Christmas, the game has fundamentally changed.
The game has changed. Your wealth is leaking. And what's fascinating here is how the institutions, the people whose entire job it is to think about long-term risk, how they responded to this monetary pressure.
Right.
The sources used a powerful term to describe fiat currencies, like the US dollar, the euro, the pound. They called them sand money.
Sand money. I like that. That's a great visual. Why sand?
Because of its gradual but inevitable value loss.
It just filters through your fingers.
Exactly. It doesn't instantly evaporate, but it slowly filters away over time through inflation and all these systemic vulnerabilities.
And that vulnerability wasn't just a hypothetical thing, was it? It was amplified by specific policy actions mentioned in the sources.
Very specific actions. For example, the sources pointed to discussions around proposed digital IDs in the UK.
Okay, I remember that.
Or reported bank access restrictions in regions like Vietnam.
So things that make people nervous about access to their own money.
Precisely. These developments, whether they're real or just perceived, they introduce the idea that your wealth is not just subject to inflation, but potentially to state or systemic control.
Right.
They amplify perceptions of vulnerability in digital and paper-based systems, and that just fuels the move toward assets that cannot be digitized or restricted by government policy.
And that vulnerability drove a massive, a truly dramatic response from the world's central banks in 2025.
A truly strategic and historic response. Central banks globally acquired somewhere between 900 and 1,000 tons of gold in 2025 alone.
1,000 tons.
And the result of this aggressive buying, this is the key part, it positioned total global gold reserves ahead of the holdings of U.S. Treasuries for the first time since 1996.
Let's just pause on that for a second, because the significance of that is it's profound.
It is.
The world's central bankers effectively made a public declaration that they trust gold more than they trust the U.S. dollar system for the first time in a generation.
It's a generational shift in reserve strategy.
Wow.
It signals an active, coordinated diversification away from reliance on the dollar as the sole global reserve mechanism.
And it wasn't limited to just gold, right?
Not at all. Russia, for instance, was noted for adding silver to its balance sheet, and major oil producers like Saudi Arabia expanded their positions initially through easily accessible ETFs.
So how did that strategic risk mitigation trickle down from the central banks to, say, the private institutional sphere, the big asset managers?
It resulted in a radical portfolio redesign. I mean, truly radical.
How so?
Analysts at major financial firms, the sources named Bank of America and Morgan Stanley, recommended a profound adjustment to the long-venerated 60-40 equity bond portfolio model.
The classic 60-40.
The classic. For decades, that 40% bond allocation, often heavily weighted to U.S. Treasuries, was considered the ultimate safe hedge.
And what was the recommended adjustment?
They recommended shifting to a 60-20-20 model.
So 60-20-20.
The 60% in equity stayed, but the 40% bond allocation was cut in half, with the remaining 20% allocated to physical gold.
Wow. So they effectively halved their position in what was long considered the safest asset class on the planet.
That's it. And the rationale was crystal clear. Mitigate exposure to fiat currency risks and geopolitical volatility.
Citing what?
Citing ongoing conflicts in Ukraine, the Middle East, alongside the escalating U.S.-China economic tensions, the institutions are seeking true insulation.
So when global risk makes all the digital and paper claims feel vulnerable, that brings us back to silver, the one with the most explosive gains. And here's where it gets really interesting. Silver isn't just money. It's infrastructure.
That dual identity is silver's unique story. It's the key to understanding that 142% move. It combines its historical monetary function, a store of value, with its indispensable industrial application.
And the numbers on that industrial use are staggering.
They are. In 2025, industrial uses accounted for a whopping 59% of total demand. It is literally being consumed by the future.
And that consumption, coupled with all the monetary demand we just talked about,
Right.
created a structural market deficit.
Yeah.
What was the number?
It was surpassing 200 million ounces.
200 million ounces. That is a massive gap that needs to be filled every single year.
It is, and it's a core reason the price surged so violently. Demand is fundamentally outpacing the ability of global mining output to supply it. It's simple math at that point.
So let's look at where that industrial demand is coming from. We have to start with solar, right?
Absolutely. We have to. Solar panel production has grown 140% since 2016.
140%.
To put that into perspective, every single residential solar unit requires about 20 grams of silver.
Okay.
Projections in the source material show that the solar sector alone could consume 150 million ounces annually by 2030.
150 million ounces just for solar.
Just for solar. That is an enormous recurring industrial drain on a very finite supply.
But silver is vital across all emerging technology, not just green energy.
Precisely. We see massive demand from AI data centers, which could soak up between 25 and 40 million ounces annually.
And that's a new demand driver that didn't even exist in a meaningful way 5 years ago.
Not at all. Then you have electric vehicles, sophisticated consumer electronics, medical applications. In all these, silver is indispensable.
Why? What makes it so special?
It is simply the top electrical conductor available, period. It offers unmatched performance in heat and power management.
So it's not really replaceable.
not without a major loss in efficiency. Its scarcity and its technological importance are why the U.S. government officially designated silver as a critical mineral in 2025. That designation alone signifies systemic importance.
And then industrial necessity. It leads us to the real-world implications of the 2025 rally,
It does.
which were the physical shortages and the breakdown of reliance on paper contracts.
Yes, the source material highlights that industrial manufacturers, they increasingly prioritize securing physical silver over just betting on futures contracts.
This is where the paper market, which is often, 100 times larger than the physical market,
Yeah.
it started to fracture.
That's the perfect word for it, fractured. For continuity of operations, the sources noted that industrial buyers essentially viewed prices above $65 an ounce as secondary
Secondary to what?
to guaranteed physical delivery.
So the conversation completely shifted. It went from, what's the best price I can get on a futures contract, to, I need a physical truckload tomorrow, whatever the cost, just to keep the factory running.
Exactly. The guaranteed supply became more valuable than the price on a screen. And this acute shortage led to some truly extraordinary measures in direct sourcing.
Where they bypassed the established exchanges entirely.
Completely. Like COMEX, they just went around them.
This Samsung and La Parrilla example in Mexico, that stands out as a fascinating example of industrial power being used to secure physical supply.
It's the perfect illustration of this entire shift. In October 2025, Samsung provided $7 million to restart Mexico's La Parrilla silver mine.
Now, this wasn't a loan or an investment in their stock,
No, it was an offtake agreement.
which is essentially a prepayment deal.
That's right. In exchange for the $7 million, Samsung secured the exclusive rights to the mine's entire silver output for 2 years. They are cutting out the entire financial middleman to secure physical ounces directly from the earth.
And that direct sourcing strategy, it mirrors what major governments, especially China, have been doing with gold for years, right?
It does, purchasing doré gold, that semi-pure alloy, straight from the mine in bulk from South America and Africa.
So it's a sign that everyone, from corporations to governments, is losing faith in the intermediaries.
It demonstrates that institutional trust has pivoted fundamentally toward physical control and proximity. And then you have the broader geopolitical context of 2025 intensifying this entire strategy.
The sources compared the geopolitical stress levels to a very specific and very scary historical flashpoint.
They did. Stress levels due to ongoing wars and major power rivalries were cited as comparable to historical flashpoints like the Cuban Missile Crisis. This acute global tension intensified demand for assets that offer immediate physical control, assets that cannot be seized, digitized, or frozen through sanctions.
And the contrast is stark. Distant digital claims versus physical metal you can actually hold.
It is. So, if we connect this to the bigger picture, the forces driving the 2025 metal market, we're talking decades of structural supply deficits, persistent fiat inflation, and rapidly declining institutional trust. These are not fleeting trends.
No.
They are powerful structural elements that drove a profound and sustained flight to tangible assets, and they look set to persist right into 2026.
So what does this all mean for the financial landscape moving forward?
Well, I think it means the core drivers we've discussed, persistent inflation, the accelerating de-dollarization by central banks, and this overwhelming non-negotiable industrial consumption are fundamentally structural dynamics now.
They're baked in.
They're baked in. They point to continued market evolution and, due to silver's dual monetary industrial profile, we should probably expect heightened volatility.
Yeah.
But the underlying pressure for higher prices remains immense.
The fundamental lesson for you, the listener then, seems to be a clear distinction between physical ownership and abstract financial claims, especially in moments of systemic stress.
Absolutely. Gold and silver have served historically as stores of value and as superior conductors for a reason. Understanding this dual, tangible role provides essential context for why physical metals are viewed as superior hedges against systemic risks and currency devaluation,
And that's what distinguishes them from paper claims.
which are entirely vulnerable within that traditional financial system.
That is something worth mulling over. The very technologies that are driving modern society, AI, solar, electric vehicles, are simultaneously creating a profound structural deficit in a material, silver, that has historically served as the ultimate inflation hedge. How does this interplay between our future technology reliance and ancient material science reshape our fundamental definition of stability in the modern economy?
That's the question, isn't it?
Thank you for sharing your sources with us for this deep dive. We'll see you next time.